If you have a pension, your retirement plan functions very differently than most people's. Only 20% of people even have a pension, but it is an amazing gift, a guaranteed source of income that, along with Social Security, may cover all of your expenses, which means your planning strategy needs to change. My name's John Lee. I'm a CPA, I'm a tax professor, and I love maximizing after-tax cash flows for people. I love being efficient with tax strategy to help people get the best return on their investment possible. Most of the retirement advice online isn't focused on people with a pension. It's drawdowns when you don't have a pension of your other accounts. There's Roth conversions, etc. For example, Social Security. When you have a pension, more of your Social Security might be taxable. Okay, you may be dealing with higher tax rates if you have a pension. You can also potentially be more risky with your investments because you're not having to draw those down. Okay, so there's a lot of reasons why a pension changes everything in retirement planning. Because there's a lack of enough advice out there for those that have a pension, I'm going to walk you through an entire plan, okay, that I just did with a couple. I'm not going to use your common retirement planning software. Sometimes you put information into them and it feels like a black box, and there's a lot of decisions you can make, and it's like, I just don't know which decision is right. I put in this Roth conversion, it's saying to convert this much. How does that interact with these other strategies? If you're super charitable, sometimes you don't want as much Roth and more traditional, okay? These are all considerations I'm going to go through within this video series, okay? I'm going to call it Retire Smarter with a Pension series. This is the first video, and I'm going to introduce the free tool that I'm going to have you download in the link in the description, and it's called My Financial Independence Plan. I'm going to give you a free version of it. I cannot give you the whole thing. It's a super powerful tool. For example, I created it for my master's class to teach them how to build a financial plan and help them make an efficient tax strategy for their entire life, right? And one of my students commented, Professor Lee, this tool or this project, the financial plan that we built was worth my entire master's tuition. I was blown away. I was like, sweet, I love that. I want to share that with you. So download the free version, walk through it with me as I'm going through and building a baseline plan. That might be all you need here. In the baseline, we're not going to go through as much of the tax strategy, Roth conversion, all of that, but maybe it's enough to just lay out your plan and say, okay, I'm good. Download that in the link in the description. If you know others that have a pension and this could benefit them, please share it with them. This will hopefully be very enlightening and be a helpful video series to help give you a clearer picture and not be fiddling around with the black box software or just kind of lost in the dark. Okay, let's jump into John and Jane Doe's retirement plan. This is a real life client, name's masked, okay, but I'm going to show you the exact strategies we used to maximize and get them an extra $600,000-$700,000 added to their net worth using all these strategies. But let's just build the baseline first. So hopefully you've downloaded the tool by now, the MyFi Plan 2025 version of the tool. To start off, here's your dashboard. This is what is going to populate as we're completing the tool. It's going to show you current net worth. How much tax did you save this year? What is your projected net worth for your retirement? What's your projected end-of-life net worth? And finally, financial independence targets. At what point can you stop working and live off your investments? Okay. Coast-fi target. What point can you stop investing? Continue working just to cover your expenses, but stop investing. We're going to calculate all of these. Okay. The disclaimer, first of all, please do not share this, copy it. I want you to share my website with others so they can give me their email and download a version for themselves, but do not share the version that you've downloaded. Okay, so please read through the disclaimer. Instructions page. This is an important page. It walks you through the structure of how the My Financial Independence Plan works. The main sections are, we're going to hit net worth, budget, tax planning, future planning, and then we're going to do 11 different projections. And then you have budget tabs where you can keep track of your income and expenses, and it all flows into your plan. Okay, but we're going to start by filling out our profile. And then we have the dashboard and financial independence plan tabs that are a summary of your plan. Okay, so dashboard gives you the charts, graphs, etc. And the My Financial Independence Plan gives you the actual numbers, your budget, your net worth, etc. Okay, so that's what we're going to go through. Instructions. If you're ever not sure where you want to do something, it's all hyperlinked. So I'm going to jump over to the budget tab, go fill that out, and then you can just click instructions up top to go back. If there's a strategy, you're like, oh, I want to do a Roth conversion. Everything's hyperlinked, okay? So I'm going to put it, I want to pay down my debt. That's one of my goals. I'm going to click there, and that brings you to the spot where you can enter the strategy to pay down your debt. Okay, so that's kind of how it all works, but we're going to take it page by page, starting with our profile. Okay, so projection date, the beginning of the current month. Well, I started this projection for this couple just so my numbers match up, September. Okay, but if you were starting this in December, for example, 12/1/25, and let's put the dates of birth. I'm going to just mask identities. I'm just going to put March 1st, 25. They were not born in 25. Let's do 62. Okay, so 3/1/1962, and we're just going to do the same birthday for both John and Jane. Okay, 60. They're both 63. Okay, and as I'm going through this, you'll find that John and Jane are probably in the top 1%. Amazing pension, amazing savings, low expenses. They're going to retire or they're going to die with $7 million or so. And you're going to say, hey, Professor Lee, come on, give me something that applies to me. Well, all of these strategies can apply to you, okay? So walk through it, but this isn't just one of those generic videos where I'll tell you, oh yeah, this is what you do. You can do your own plan yourself as we're going through. I encourage you to do that, okay? So household status, select your household status, or you can walk through their situation with me first, make sure yours matches, and then go change it to yours if you want. They're married, oldest child 18 or over, has moved out. Okay, that's pink because that's updating the budget tab. You can see when you're going through this My Financial Independence Plan, you're going to change colored boxes. You can see the white boxes have formulas in them. They're going to be locked down for your version. So, but just so you don't override those formulas, but you're just changing the colored boxes. Okay. For John, so wages 114,265. Gross wages 114,265, and then for Jane 116,287, 116,287. Another thing that's going to jump out, you're going to say, oh wow, you entered a bunch of a good income, and now end of life net worth dropped to negative 2.7 million. What's going on? Well, each thing we're entering here, the amazing thing about this tool is you can see the impact of every decision you make on your final net worth. Okay, so right now, if we look. And you'll see all of this is happening in the future planning tab is where all of the calculations are happening. And because income is only lasting 2 years because of retirement dates, we have Social Security in there, and it uses the average American's budget based on your income level. So the average American is spending a lot more. So that's why we're in the negative, right? But as we enter more information, assets and everything else, we'll get that into the positive and make it more clear. This whole video is about building the baseline. We're just getting started, okay? So that's why that's negative. If you have business income, put in your gross. So, your net business income, income less expenses in those cells, okay? This couple just had W-2 jobs. Cash reserve, they want a 6-month cash reserve. You're putting that in because the excess is going to go into a brokerage account. You're going to invest it. So that's the assumption. So if you want more, you could say, I want 100,000 in cash reserves, okay? And the model will take that into account. Taxable account. So this is your brokerage account. This is outside of any retirement account you have. This is where you're investing separately from that. It's an amazing account to have when you're looking at retiring and everything else. So these are kind of a baseline percentage yield that results in a 7% return, mixed return between your stocks, your bonds, and growth stocks and dividend stocks. Okay, so you can change those and you'll see your projected return will change. And this is accumulation return, meaning as you're building up to retirement, the assumption is 7%. Again, you can change that, change your portfolio. The assumed portfolio is 80-20, okay? And then the retirement phase, we're leaving the returns the same for both, but we're changing the allocation. We're going to allocate more to bonds instead of stocks in retirement, less risky. When you have a pension, you might not have to do that. So we could make a change there in the case of a pension, okay? And then, so we can do comparisons. Remember how I said I like to know, oh, what's better, Roth or traditional? Do I put it in a taxable account or not? I'm leaving the returns the same. I encourage you to do the same thing, at least in the beginning as you're doing projections like Roth versus traditional. Later on, when you know which accounts you have and want to use, maybe you want to have the Roth more aggressive, okay? etc. You can change those here, but I'm leaving them the same for now for comparison purposes. There's your real estate appreciation rate, wage inflation rates, etc. You can change these. They're colored, so you can change them. I'm just leaving set values so you can start with those and then change them if you need. Inheritees tax on your tax deferred accounts, or if they inherit an HSA, okay, which is one of the worst accounts to inherit, so usually you want to deplete that before passing it on. Retirement withdrawal rate, we're using that generic 4% rule. And then charitable contributions, this is for tax planning strategies related to charitable. How much do you plan to give on a yearly basis? And this couples at 12%, okay? They expect to retire, the husband, 63, in the month of October, so October 2025. And Jane will be, when she's 65, so 2027, and is going to retire in the month of July. Okay? So, remember, this series is about pensions, and they both have pensions in this case, okay? Which is an incredible thing to have both have pensions. So let's go through their pension information. So first of all, for John, he just retired, so he's starting to take that pension. A lot of companies will require that. And if you get an error, like a value error, you're just missing information related to that. So like the pension start month, once we add that, October, that should clear that error. And we're back in business, okay? Final salary, so this is whatever your pension uses, either the highest 3 or 5 years. So for John, it was 130,525. And the pension multiplier for his pension is 1.1% based on the, so you're going to multiply by that percentage and then by the years of service, which is 24 in 1 month for him. So 24.08333 is what we're using for years of service. And is it indexed for inflation? Yes. Joint survivor percentage. We're going to do a bunch of planning with this in a lot of different scenarios, but to start off, let's just use 0. Okay, we're setting a baseline. Let's set it at 0. Lump sum. Does he have a lump sum option? He does not. So we're just going to put no there. So we don't have a lump sum amount. If it is a lump sum, are you going to roll it over to an IRA? And finally, so the pension amount is already projected based on those values. If it's different from what I've calculated for you, that's why you have that override cell. You can just change that to 36,000. Or if you choose a lump sum, you're going to have to decrease that amount compared to what it is above. Okay, so you will likely use that override. So 34,578. You can see net worth's looking better. We're adding a pension here. Let's now add the wife's pension. So she's going to take it at 65 in the month of July. And then her final average salary is going to be 111,932. The pension multiplier is a great pension multiplier for her, 2%. She has a very healthy pension, and this will be 25 years of service once she starts taking that pension. It is also indexed for inflation, and it has a joint survivor option. Again, we're going to put 0 just for our baseline. Also has a lump sum option. Okay, for now let's put no, not taking lump sum, but we're going to put in at least one of the lump sum options, which is 55. Well, let's put in the total equals 55,966 times 2. So she has the option to take 2 years of the pension and then receive a lower amount, but we're putting no because we're not going to put in that lower amount yet. Okay, and she would want to roll over 100% to an IRA. If you set that to 0, that full 111,000 lump sum would be taxable in the current year. Okay, so we're going to defer that tax and then can override if necessary. Wow, final net worth's looking way better already, adding the wife's pension, but we're still at negative $1 million, so it doesn't look great. We have a lot to add. Social Security. Okay, this section, it's set to the full retirement age based on the birth date you put in. Okay, 67, and you can start taking Social Security the month after turn that age. Okay, this is going to calculate, it's going to estimate your primary insurance amount based on that retirement age and your income level that was put in. It's going to say, okay, I estimate that your Social Security should be this amount, okay, based on your full earnings history that goes into the calculation. Well, is that going to be accurate if you have high swings in earnings? It might not be, okay? So what I want you to do is go to this link, secure.ssa.gov, which allows you to go ahead and you can estimate your Social Security amounts. Okay, or not estimate them, that's where the Social Security Administration estimates them for you. So, for example, my estimated amount that I calculated was $3,397 based on the husband's age and wage. Here's his actuals that he can pull straight from the website. You just put in the age and it'll give you what they estimate, which is a bit more accurate, okay? Which I was pretty darn close. $3,495 was the primary insurance amount at 67. I had $3,397. So let's override that. It's going to be $3,495, okay? If you don't pull all of these, at least pull that first one, because then you'll at least have an accurate starting point, and then the adjustments based on age. As we're doing some Social Security planning, we're going to override the age instead of taking it at 67, let's take it at 62. What effect does that have? And you can see it immediately, we were worse off by 300,000 in this case. Okay, so that's how fast you're going to get answers to your questions here. Okay, but get those insurance amounts to get it as accurate as possible. If you don't have those, the estimate will work, but it won't. Just know it won't be quite as accurate. Same thing for the spouse. Let's put in hers, which will be those primary insurance amounts, and you can see her estimate. While the estimate was close for John, for Jane, it is quite a ways off, actually, I believe. We're looking at primary insurance amounts, $2,317. The estimate was $3,425 because she had a lot lower earnings history, and then the last few years it increased significantly, which is going to overestimate if we're just using those last few years as the estimate. So we're going to come in here for the primary insurance amount and put in that $2,317. Okay, so we're just trying to get as precise as possible for our decision making. So there is our Social Security. Okay, we're almost done with the profile here. RMD age, this is based on birth year, and life expectancy age is also based on birth year. We're going to make changes to that as well. Maybe one's not very healthy and not expected to live much longer. You can override the age there, and it's going to make changes, as you can see. Okay, so there's our profile page. You can see we're still in the negatives because right now we're using the average American's expenses, and we need to update some. First of all, our net worth. This is assuming we're starting at 0. Okay, at 63. There are people in that situation, and retirement's kind of scarier for them, right? So, but let's put in their net worth. Okay. So I'm going to just grab their assets, copy them over. You would put them, just type those in. Okay, they have $54,000 in cash. Pretty healthy tax-deferred accounts. I mean, even for having a pension, people would be happy with $621,000 without a pension. Okay, but they're doing really well with tax-deferred, tax-free. They're over $100,000, and then they have some HSA, and they own their home. $1,026,000 value and $40,000 in land. Okay. They have done very well in that they have 0 debt. 0 debt on the home, 0 consumer debts. In a subsequent video, I'll go through how this debt section works. It's amazing if you have debt, how to pay it off quickly, and it shows you how much tax you're saving, etc. Okay? Just putting in their initial balances, look at their net worth now. Okay, we're feeling a lot better, $2.5 million. This is assuming that's end of life net worth. So based on using their pension, Social Security, building in RMDs and everything, they're going to have 2.5. Well, that's on the average American's budget. Let's look at how they were budgeting. Okay, how does this budget tab work? You have based on income, and this is a budget on steroids. I don't know if there's another budget tool that goes this in depth. Okay, and that's why I love it, because I love budgeting and I love knowing where every dollar goes. Okay, and it's really cool because you start with your income, it builds in your tax liability. Okay, so you know how much tax you're paying from that gross. It also builds in what you're putting in your 401k, HSA, where you're putting your money. You don't just put, oh, I'm putting this into savings. It's putting exactly where it's going, and it adds the employer match. Okay, so that goes into your savings percentage. Okay, it also adds your debts already added. Okay, so this budget's fun. I love it. It's one of my favorite parts, and you'll see how big an impact just your budget has. If you do none of the other strategies I show you in this series, if you just learn how to budget, you'll retire wealthy. Okay, here's an example of how. This couple, because they're making really good money, the average American would still be saving $32,000 this year. They're at the end of their career. Okay, so which a lot of people, they're making their highest money at the end of their career and maybe their expenses aren't as high. So that's the average Americans in column C, this annual budget. What we want to do is come into the pink cells and update them to your actual budget. So John and Jane's actual budget, for example, they're spending $54.95 on health insurance. $54.95. Average Americans at $76.48. Okay, so in their household status. So when you can see the budget updates, and you can see it'll change the savings based on whatever we put in these pinks. So health, dental insurance, $382. So we're going to go down, and these are set categories based on the Bureau of Labor Statistics. That's how I can do the average American budget. So put whatever your expenses are for these main categories, but then if you have others, just other category. You can come override those other categories and add your own. Okay, so I'm going to go ahead and just, for the sake of speed of the video, I'm going to copy that budget overrides column and paste values. Okay, so now you'll see average American's giving $5,900 in charity. This couple's giving $25,000. Okay, so it just updated to their budget. They're giving a lot more charitable because they live well within their means. Look at their expenses. The average American was 144. They're at 70. Their savings, 105. Look at their final net worth. Again, how important is that budget? They were at 2.5 and now they're at 7.7. We didn't do any tax strategies. We didn't do anything else. It was just budgeting. Okay, spending less than you're making, and we're gonna. You can see they put $7,900 in cash because they hit their cash goal, and then everything else is going into that brokerage. Okay, so that's a more clear picture of where their baseline scenario. Now that we've completed profile page, we know what the net worth is. We've set the annual budget. Again, one of the most important things. Let's do some tax planning. My favorite part, right? Budget's probably the most important part. Tax planning is my favorite part. So in the tax planning, cool thing about how I've built this is as you enter stuff, it creates your tax return for you. So you can come put your name in here, John Doe, and you shouldn't file this return out of Excel, but it's creating it for you, so you can really get a close estimate to where you're going to be at for 2025. You can see there's the income we put in. It has John's pension income for those 3 months of pension, AGI, their standard deduction, which it looks like itemized deductions exceed the standard, so it's using itemized, tax due, and what they paid in, which we haven't added that yet. So on this tab, that's where we add all the tax information. Change the filing status if you need. Okay, and again, these gray are going to be set formulas from other pages, and then your blue cells for this tab are your overrides that you can put in your state. State isn't as accurate as the federal is going to be. Utah, I have used the form, so Utah is super accurate because I'm in Utah, but as I build this out more, the other states will be more accurate, but for now, it's just using the tax rate schedule for each state. So if you need to change your state, change to whatever state you're in, okay? So we already have our wages from the profile page. Let's add federal income tax withheld. So tax planning, so $12,398 was what was withheld for federal, $12,398. And for state, we have $3611. Then for spouse, $66,380 was withheld for federal, and state we have $3627 withheld. We also have ordinary dividends of $1620. We're just putting any of our income that's going to be reported on our tax return. And they don't have any other income. They have that pension that started for John. But other than that, no other income, short-term gains and losses. They weren't selling anything. Now we get to our deductions. Student loan payments you can enter. Qualified car interest for the new car interest deduction. State and local taxes are at $13,731. And then mortgage interest is at $779. Some points left over. And then the charitable is coming straight from their budget. So they're at $39,000, is their itemized deduction amount. So that should be it for the baseline scenario. Okay, so what that did, you can see my 1040, I have my withholding now, so if they don't do any tax strategy, they're owing 15 grand at tax time, which is going to be subject to penalties, etc. They obviously paid in less because they're going to be applying a bunch of tax strategies to save on tax this year. But there's income, there's federal tax due, $34,000. State tax, they're going to owe $10,800. Social Security and Medicare, about 17 grand. This is the free version of the tool, okay? You can go in and make changes to, what if I have business income, okay, of 100,000? What if I start this side gig and do really well? This is going to update everything, right? And it's going to, and that's only going to go through your retirement age, but it's going to calculate your self-employment tax, QBI deduction, all that, okay? So you can go through and play with it. This is what you get with the free version, the baseline scenario. So what I'm going to do, the last step, we're at 7,757,14. Here, now that we've made it here, I want you to click Set Baseline Scenario. This is a macro that runs through and locks in what we've just built. Because now, what we're going to do is, we're looking at 7.7 million, okay? You're like, oh, these guys, do they need to do anything? We're not too worried. There's so much they can do, okay? In strategy to maximize their after-tax wealth, but also maximize the amount they can give to others, to inheritees, or to charities they're passionate about, okay? So that's the goal. So we've just locked in the baseline scenario. So on the projections tab, you can see this current projection shows whatever we're doing currently, okay? And it starts with current year tax, and it goes all the way through financial independence thresholds, retirement, and then end of life. And it just copies all of your criteria that you've put in to get to 7.7 million. It's all right there. So now when we make changes for projection 1, we'll see what happens with projection 1, okay? And just to give you an example, I'll show you the end result that you can look forward to building out with me throughout this series. So we started with the baseline, okay? We're at that 7.7 million, right? 7.7 million. We do 10 different projections, strategies that by projection 10, they have an extra $640,000, okay? What are these projections? I mentioned them briefly at the start. Let's look at the top. This is where we're going to talk about 401k match, investing the savings into Roth. We're going to talk traditional versus Roth, compare those. We're going to talk about HSAs, how to maximize HSA, okay? We're going to do how do you max out traditional 401k, more Roth, charitable strategies. This couple, the amount they are saving because of their charitable strategies is incredible, okay? QCDs, DAFs. We're going to go through charitable stacking, the ever popular Roth conversion, okay? We're going to jump through, okay, they have pretty good income throughout. What should we do about Roth conversions, okay? Pension planning. This is where do we do the survivor benefit. It's going to cost me this much, but the benefit if a spouse dies early is this big, okay? Social Security planning. What age should we take Social Security? And finally, the last one was, what if they just gave that remaining tax-deferred balance to charity? You know, what effect does that have on the plan? We ended at 8.4 million. That is what I'm going to show you. If you found this helpful, please share it with others. Anyone that could, you know, I'm focused on pensions right now, but you could share it with someone who doesn't have a pension but needs a retirement plan. Just don't fill out the pension section, okay? But if you know someone with a pension, please share it with them because this can hopefully help them as they build out their retirement plan. And yeah, if you found this useful, please send it to others. Subscribe so you get update for the next video where I start walking through these scenarios. Have a good one.